the cloud isn't actually in the sky. I mean, when you and I think about artificial intelligence, we tend to visualize something, I don't know, completely ethereal, right?
Yeah, like invisible algorithms just, processing billions of data points in the ether.
Exactly. Software, code, these virtual networks that somehow exist everywhere and nowhere all at once. It feels totally weightless.
Right. But the second you look at what is actually required to build the cloud, that weightless illusion just completely shatters.
It really does. The cloud is on the ground.
Yeah.
And it is heavy. I mean, it requires land, it requires massive amounts of power, and, well, most importantly for our deep dive today, it requires an unimaginable amount of physical infrastructure.
Yeah, the AI revolution is fundamentally, it's a construction boom.
It is, which is wild to think about.
It's the absolute definition of heavy industry colliding with high tech. You simply cannot have artificial intelligence without hyperscale data centers, right?
Yeah.
And you can't build those data centers without concrete.
Tons and tons of it.
Millions and millions of tons of it, actually. We talk about data lakes and machine learning like they're divorced from the physical world, but they sit on very real physical foundations.
Which brings us perfectly to today's focus. Welcome, everyone. We are stepping into our Talk Tickers framework today.
Yeah, and if you're new here, that means we are data forward, we use plain language, and we cut out all the Wall Street fluff.
Exactly. We want to give you actual, actionable insights. And today, we're looking under the hood of a company that most people just associate with the old economy. I mean, it's a 100-year-old Mexican cement maker.
Right. We are talking about CEMEX. Ticker symbol is CX.
Yep, CX. We are cracking open their Q2 2026 earnings call today because, well, this boring cyclical material stock might actually be the stealthiest AI infrastructure play on the market right now.
Yeah, the broader market just fundamentally misunderstands what is happening inside this company. I mean, our goal today is to break down the heavy machinery of their financials, translate all that dense management jargon, and, give you a clear data-backed take on whether this stock actually belongs on your radar.
Right. And it all starts by looking at an earnings report that genuinely shocked a lot of analysts, the ones who still view this purely as a legacy construction play anyway.
Let's get right into those headline numbers because they are staggering.
Okay, lay them on me.
So adjusted sales increased 11% year over year.
11%, wow.
Yeah, that is organic top-line growth across almost all of their global markets.
Yeah.
Double-digit revenue growth in a heavy materials business is a massive signal.
Especially right now, in a macroeconomic environment that has been incredibly choppy. I mean, high interest rates are supposedly cooling off construction worldwide, right?
Right, exactly. So the top line is impressive, but the bottom line is where the structural transformation is really visible. Their EBITDA so, earnings before interest, taxes, depreciation, and amortization, it crossed the $1 billion mark for the second quarter alone. $1 billion.
Hitting $1 billion in EBITDA for a single quarter is a huge milestone.
It really is.
I mean, that's $1 billion in pure operational cash-generating power before the accountants and the tax man even touch it. It shows the raw horsepower of the business.
Yeah, absolutely.
But, I was digging through this transcript before we started recording, and my spidey sense started tingling a bit.
Uh-oh. What did you find?
Well, management loves to parade $1 billion headline number, but I noticed that this figure includes a $42 million one-off settlement for an outstanding commercial claim in Europe.
Ah, right. A good catch.
So I'm looking at this and thinking, management is just padding the stats here. Are these headline numbers artificially inflated by a legal payout? Because if the lawyers hadn't handed them a $42 million check this quarter, would we even be talking about a blowout earnings call?
I love that you caught that because stripping out those one-time windfalls is exactly how you find the truth in an earnings report. But let's do the math here.
Okay, let's throw it.
Let's pretend that $42 million European settlement never even existed. If you completely remove it, their adjusted EBITDA still rose 19% year over year.
Right, 19%. So the core business is growing profits at 19%, while sales only grew at 11%.
Exactly. And if you take it a step further and look at EBIT, which is earnings before interest and taxes, but actually factors in the depreciation of their massive physical plants and equipment.
Right, the heavy machinery.
Yeah. That metric expanded by an incredibly impressive 29%.
29%. So operating profit is growing almost 3 times as fast as top-line revenue.
Yeah.
I mean, for anyone holding this stock, that is the holy grail. That is just pure operating leverage. They are wringing significantly more profit out of every single dollar of cement they sell.
which is reflected directly in their margins. The EBITDA margin expanded by 1.4 percentage points on an adjusted basis, reaching 21.4%.
That's huge.
And the chief financial officer, Maher Al-Hafar, he provided some vital historical context on the call. That margin is at its highest level since 2008.
Since 2008. Wow, that is crucial context. Because cement is historically a massive boom and bust industry, right?
Right, exactly.
The last time CEMEX saw margins this high, we were at the absolute peak of the mid-2000s global real estate bubble.
Yeah.
Just right before the global financial crisis wiped out the entire construction market.
Yep, top of the roller coaster.
But we aren't in a massive real estate bubble right now. I mean, the macro environment is actually pretty tough. So hitting 2008 level margins today implies something fundamentally different is happening inside the business itself.
You're touching on the difference between cyclical luck and structural efficiency there. Right. In 2008, high margins were just driven by an unsustainable frenzy of demand. Today, those margins are being driven by internal operational discipline. And the ultimate proof of that discipline is cash flow.
Oh, I'm so glad you brought up cash flow. Because margins on a spreadsheet are great. But, accounting profits can be manipulated with depreciation schedules and inventory valuations.
Absolutely.
Cash in the bank cannot be faked.
Yeah.
So what did they actually generate in cold, hard cash?
Well, free cash flow from operations hit a record $651 million for Q2.
Free cash flow is just the lifeblood of any company.
Oh, totally.
It's the cash left over after paying all operating expenses and all capital expenditures, meaning it's the money they have to spend just to keep the kilns firing and the trucks running.
Right.
So that $651 million is the money that is truly free to pay down debt, buy back stock, or return to shareholders.
Yeah, and just to give you a sense of the acceleration here, that is an increase of more than $400 million year over year, adjusting for some severance and discontinued operations.
$400 million, that's insane.
They essentially tripled their free cash flow from operations compared to Q2 of last year.
Wow.
And their trailing 12-month free cash flow conversion rate, which just measures how efficiently they turn accounting profit into actual cash, it jumped from 33% a year ago to 60% today.
Okay, so if you're an investor looking at these headline numbers, you have sales up 11%, underlying profit up 19%, margins at an 18-year high, and free cash flow tripling.
It's quite the scorecard.
It is. But, cement is a legacy 100-year-old technology. You don't just wake up one morning and accidentally become this much more profitable. Hitting $1 billion in EBITDA requires a deliberate mechanism.
Yeah, it doesn't happen by accident.
We really need to look at what they're physically doing inside their plants to squeeze out this cash. Let's move to section 2 of our Talk Tickers deep dive, the story behind the numbers.
The mechanism driving all of this is a multi-year internal transformation initiative that management calls Project Cutting Edge.
Project Cutting Edge.
Yeah, the CEO, Fernando Gonzalez, stated on the call that this specific program generated $60 million in pure efficiencies just during this single quarter alone.
I hear corporate buzzwords like Project Cutting Edge, and I usually just roll my eyes.
I know, me too.
Most corporate cost-cutting programs are just empty buzzwords. It's like going on a diet by switching to zero-calorie soda but still eating 3 whole pizzas a day.
Right, exactly.
The company announces a reorganization. Maybe they fire a few middle managers, but the fundamental cost structure remains totally bloated.
But the data shows this is not a cosmetic diet. They are physically restructuring their asset base.
Honestly, I think a better analogy here isn't a diet, but like an overgrown garden.
Oh, I like that.
Because in the past, cement companies treated their assets like a sprawling forest, right? They just wanted to grab as much land, as many quarries, and as much market share as possible, even if half the plants were rotting and draining resources.
That was the playbook, yeah.
It sounds like Project Cutting Edge is them finally bringing in a master botanist. They are cutting off the dead branches so that all the capital flows directly to the fruit-bearing operations.
That is an incredibly accurate way to frame it. Actually, management even calls this asset pruning.
Asset pruning.
Yeah. During the second quarter alone, they dispose of 12 facilities.
12.
They are going through their global portfolio, plant by plant, quarry by quarry. If a ready-mix facility is underperforming or consuming maintenance capital and burning cash without generating a sufficient return, they aren't waiting for the market to improve. They are just cutting it loose.
Man, that represents a massive psychological shift for this industry. For decades, the entire sector was just obsessed with sheer volume. You kept the plant running, even at a slight loss, just to maintain your geographic footprint and keep competitors out.
Exactly. But under this new operating model, local management teams are no longer incentivized just to push volume. Their compensation is tied to metrics like return on invested capital and free cash flow.
Oh, that changes everything.
It does. If a specific plant isn't carrying its weight, the local managers are now financially motivated to get rid of it. But the pruning is really only half the equation. The other half is optimizing the core assets they keep, particularly when it comes to energy.
Which is the biggest variable cost in the cement business.
By far.
Making cement requires heating these massive rotary kilns to volcanic temperatures, like around 2,700 degrees Fahrenheit, right?
Yeah, it's intense.
It takes an unbelievable amount of fuel. But looking at the transcript, their energy costs actually decreased by 6% per ton of cement produced. And that was supported by a 10% reduction in total fuel costs during the first half of the year.
And that cost reduction wasn't a gift from the global oil markets either. It was engineered.
Engineered how?
They are aggressively ramping up the use of alternative fuels. In Mexico, for instance, they have effectively utilized alternative fuels like municipal solid waste, biomass, and industrial byproducts as a physical hedge against spikes in primary fossil fuel prices like petcoke and coal.
I really want to break down how that mechanically works for you, the listener, because physical hedge is a brilliant concept.
It really is.
Usually when we talk about hedging, we mean financial derivatives,
Yeah.
right? Buying futures contracts on Wall Street to lock in a price. But CEMEX is modifying their actual kilns so they can burn trash and agricultural waste instead of coal.
Yeah.
So if the global price of coal spikes because of the supply chain shock, CEMEX just turns a dial, burns more alternative waste, which is often sourced locally and incredibly cheaply, and their profit margins barely flinch.
By engineering their equipment to handle variable fuel sources, they completely decouple their cost of goods sold from the volatility of global commodity markets. It is a structural advantage that competitors who haven't upgraded their kilns simply do not have.
So the pruning in the kilns are driving the margins.
Right.
But you can't just cost cut your way to long-term prosperity. You also need massive demand. And this is where the regional data tells a fascinating story, because we are seeing a sharp divergence in their core markets right now.
We definitely are.
We have to talk about Mexico, because right now Mexico is the undisputed star of the portfolio.
Mexico essentially carried the entire company this quarter. They reported their second consecutive quarter of year-over-year volume growth. And what's driving this is a fascinating mix of the informal sector, so everyday people expanding their homes through self-construction, and massive government-backed social programs.
Yeah, the government social housing numbers cited on the call are huge. The current administration has a stated target to build 1.8 million social housing units by 2030.
That's a staggering amount of construction.
And to date, CEMEX has been awarded contracts for approximately 135,000 of those units. That alone is a 12% increase from just the prior quarter, and they are currently in negotiations for another 145,000 units. For an investor, that looks like a guaranteed multi-year pipeline of demand.
The pipeline is very real. But if we are applying a critical eye to this stock, and we should be, we need to address a major caveat that management admitted on the call.
Right.
The Mexican margins are currently spectacular, yes, but they are slightly inflated by a temporary anomaly.
Yeah, I noticed that. Other cement producers in central Mexico experienced unexpected operational outages. Their kilns went down, CEMEX was operating efficiently, so they swooped in, filled the supply gap, and captured that market share. But I have a hard time believing this isn't just a temporary spike. A competitor's broken machine isn't a permanent competitive moat, I assume management knows they can't maintain this margin forever.
Oh, they are well aware of it. Gordon Lee, an analyst from BTG Pactual, pushed the CEO on this exact point during the Q&A. He asked if these Mexican margins were sustainable, and Fernando Gonzalez was refreshingly transparent.
What did he say?
He stated flat out that they expect Mexican operations in the second half of the year to operate at a slightly lower margin level. The competitor outages will resolve, and CEMEX also has some of its own scheduled maintenance outages coming up.
Makes sense. There is also a product mix dynamic happening here too. They sold a massive amount of bagged cement in the first half of the year compared to bulk cement.
Let's explain why that matters to the bottom line, because it's important.
Yeah, go for it.
Bagged cement is exactly what it sounds like. 50-pound bags sold at retail hardware stores or directly to small contractors for residential self-construction. Because it is branded and sold in smaller quantities, it carries significantly higher profit margin.
And bulk cement.
Bulk cement is transported in massive tanker trucks to large-scale commercial or infrastructure projects. And because those buyers purchase in massive volume, the margins are much, much thinner.
Right, and as we move into the end of 2026 and into 2027, the Mexican government is shifting focus from residential social housing to massive infrastructure projects, highways, railroads, industrial parks. That means CEMEX's product mix is going to shift heavily toward that lower margin bulk cement.
The overall volume of cement sold might actually go up, but the profit per ton will soften slightly. So if you are analyzing the stock, you have to model for a slight cooling off in Mexican margins, even if the absolute revenue remains strong.
Okay, so Mexico is operating at peak performance, but preparing for a slight normalization. Now let's look north of the United States.
Yeah, the U.S. numbers are interesting.
Because on the surface, the U.S. numbers look completely contradictory to the rest of the company. It looks like a major drag.
It was a very challenging quarter in the U.S., no doubt. Management reported that their regional EBITDA and margins were heavily pressured by bad weather in Texas and the Mid-South, combined with rising materials and freight costs.
I really want to dive deep into this Texas weather issue because I think a lot of retail investors who are used to tech stocks forget how brutally physical this business actually is.
Oh, totally.
If you invest in a cloud computing company, a massive thunderstorm in Texas doesn't impact their quarterly revenue. The software still runs. But for CEMEX, an unusually wet spring completely stalled their operations.
Yeah, they experienced major disruptions, specifically at their Balcones quarry in Texas, which is one of the largest crushed stone quarries in the entire United States.
Let's just explain the physics of this for a second. When a quarry floods, you literally cannot mine aggregate rock. The heavy machinery just sinks into the mud.
It's completely unworkable.
Furthermore, when commercial construction sites across the state are a muddy mess, contractors cannot pour ready-mix concrete. You can't pour a foundation in a swamp. The demand for the concrete doesn't disappear. The buildings still need to be built, but the revenue gets delayed into the next quarter.
And that delay creates a cascading nightmare for the supply chain, which crushes margins. Because they couldn't deliver the crushed rock directly to the construction sites, they had to excavate it, load it onto trucks or rail cars, and move it to temporary storage yards just to keep the quarry producing once the rain stopped.
Wait, moving heavy rock twice. That means you are paying double for freight. You are paying fuel and labor costs to move inventory into storage, and then you will have to pay those costs again to eventually move it to the customer.
Exactly. The CEO noted this essentially wiped out their margin growth in the aggregates business for the entire quarter.
Ouch. It looks terrible on a spreadsheet.
It really does. But here is the critical takeaway if you are considering buying this stock. This is a temporary weather-related logistical nightmare, not a structural decline in U.S. demand. The underlying hunger for construction materials in the U.S. is still incredibly robust.
Yeah, the chief communications officer, Lucy Rodriguez, she brought the receipts on this. She noted that if you statistically adjust for those unseasonable weather delays, U.S. cement and ready-mix volumes would have actually grown 1%, and aggregate volumes would have expanded a massive 7%.
7% organic growth in heavy aggregates wiped out purely by rain. That proves the fundamental demand is intact. And that demand is being heavily underpinned by federal infrastructure spending, specifically the IIJA, the Infrastructure Investment and Jobs Act.
Right, that's the $1 trillion infrastructure bill passed a few years ago. You would think that money's already been spent and priced into the stock by now, though.
Not even close, actually. Management highlighted that only about 50% of the funds allocated to highway and street projects have actually been put to work so far.
Only 50%.
Yep. There is a massive multi-year backlog of federal money still waiting to be poured into bridges, highways, and public works across CEMEX's U.S. footprint. The weather delayed it, but the money is still there.
Wow. Okay, so we have Mexico cooling slightly from an absolute peak, and the U.S. temporarily stumbling on mud, but sitting on a massive backlog of federal dollars. Let's cross the Atlantic and look at Europe, the Middle East, and Africa. the EMEA segment.
This region is fascinating.
It completely blew my mind. It is a perfect case study in how complex running a multinational heavy industry actually is.
Europe faced incredibly soft demand this quarter. High interest rates from the European Central Bank essentially suffocated residential construction.
Right.
And on top of the macroeconomic headwinds, they faced extreme environmental challenges. Severe heat waves physically forced construction sites across southern Europe to restrict working hours just to protect workers.
Again, the brutal physical reality of the business. If it's 105 degrees in Spain, you can't safely have crews pouring concrete in the afternoon. So construction slows down and volumes drop. But here's why my mind was blown. Despite selling significantly less product, their adjusted EBITDA in the EMEA region still grew 9%. How is it mechanically possible to grow your profit by 9% when your actual sales volume is shrinking?
It comes down to ruthless pricing discipline and the structural advantages of Project Cutting Edge. They successfully forced price increases through to their customers to offset the inflation they were seeing in energy costs.
Okay, that makes sense.
But more importantly, they are benefiting immensely from a regulatory framework that is just punishing their competitors. I'm talking about the EU ETS, the European Union Emissions Trading System.
Okay, we need to translate this because EU ETS sounds like bureaucratic alphabet soup. If I'm a retail investor looking at a Mexican cement company, why do I care about a European emissions trading scheme?
You care because it is turning environmental compliance from a massive tax burden into a lethal competitive weapon.
Interesting. How so?
Well, the EU ETS is a cap-and-trade system designed to reduce greenhouse gas emissions. In simple terms, the European government sets a cap on total emissions. If a company emits carbon, they have to buy allowances to cover those emissions.
And manufacturing cement is notoriously one of the most carbon-intensive industrial processes on the planet.
Exactly. The core ingredient in traditional cement is something called clinker.
Let's explain clinker because management kept talking about the clinker factor on the call. What is it and why is it so dirty?
So clinker is, it's created by taking limestone and superheating it in those massive kilns we just talked about.
Right, the ones hitting volcanic temperatures.
Right. The chemical reaction that transforms limestone into clinker, it physically separates the carbon molecules from the stone itself.
Oh, wow, so it releases it.
Yeah, it releases massive amounts of CO2 right into the atmosphere. You literally cannot make traditional clinker without releasing carbon. It's just, a chemical inevitability.
So how does a cement company survive a massive carbon tax?
By heavily reducing the clinker factor. Okay. The clinker factor is the ratio of clinker to other materials in the final bag of cement. CEMEX has been investing hundreds of millions of dollars over the last decade in green technology to substitute that carbon-heavy clinker with other industrial byproducts.
Like what kind of byproducts?
Like fly ash from coal plants or slag from steel mills. They announced on the call they reached a record low clinker factor of 62.6% in Mexico, and they are executing the exact same playbook in Europe.
I see where this is going. Because CEMEX started investing in decarbonization years ago, they have drastically lowered their carbon footprint. But a lot of smaller regional European cement producers didn't make those investments.
Correct. The CFO explained how this dynamic plays out mechanically. As the European Union tightens the cap and makes carbon allowances more expensive, the gap between the leaders in green tech like CEMEX and the laggards widens dramatically.
Right.
The competitors who are still producing carbon-heavy cement are being crushed by carbon taxes. To avoid bankruptcy, those competitors are forced to aggressively raise their prices.
And that creates a pricing umbrella for CEMEX. I mean, if the dirty competitor has to raise their price to $120 a ton just to pay their carbon tax, CEMEX can raise their price to, say, $118 a ton.
Exactly.
CEMEX's costs are lower because they aren't paying the massive tax, so that price increase goes straight to their bottom line as pure profit margin, and they still undercut the competitor on price.
It is brilliant corporate strategy. They have weaponized their environmental compliance. They don't need construction volume to grow in Europe because their margin per ton is expanding rapidly as competitors literally price themselves out of the market.
That is an incredible translation of how regulatory policy directly impacts a stock's bottom line. So let's bring all of these regional dynamics together.
Yeah.
With Mexico normalizing, the U.S. waiting for the mud to dry, and Europe navigating heat waves and carbon taxes.
Yeah.
How is management forecasting the rest of the year?
Yeah, Section 3, management guidance.
Which is arguably the most important part of any earnings call for an investor.
And this is where the confidence of the management team really shocked the street. Despite all the macroeconomic volatility, despite the weather, despite the European slowdown, they actually raised their full-year EBITDA growth guidance to a range of 16 to 17%.
Raising guidance in a high-interest rate macro environment is a bold move. It signals they have immense visibility into their project pipeline.
They backed up that confidence by simultaneously raising their internal cost savings target under Project Cutting Edge. They originally told Wall Street they aimed to save $400 million. On this call, they announced they have already achieved 80% of that target.
Oh, wow.
Because they are executing so efficiently, they raised the total savings goal to $475 million, which they expect to fully realize by 2027.
But where is that extra $75 million coming from? I mean, we already talked about them selling off 12 underperforming facilities and swapping out fossil fuels for municipal waste. They've pruned the garden, right? What is left to cut?
The CFO, Mar Al-Hafar, broke this down beautifully during the analyst Q&A. The $475 million is split into two distinct buckets. About $230 million is coming from overhead reduction.
Like what?
Eliminating corporate bloat, streamlining regional redundancies, and flattening the management structure. The remaining $245 million is coming from deep operating efficiencies.
Operating efficiencies like what? What does that actually mean on the ground?
Procurement and logistics. They are fundamentally transforming how they buy things and how they move things. They are upskilling their supply chain teams, renegotiating massive freight contracts, optimizing trucking routes using data analytics, and dynamically managing how they buy energy across different global grids.
Speaking of buying energy, this is where I need to play devil's advocate.
Okay, let's hear it.
I want to push back hard on management's confidence in this 16 to 17% growth target, because the CEO explicitly flagged a massive, uncontrollable geopolitical risk on the call. He said their new cost efficiency targets are, and I quote, subject to potential slippage resulting from possible cost headwinds from the Iran war.
Yes, it is the elephant in the room.
We established earlier that cement is an incredibly energy-intensive business. You need a massive amount of diesel fuel to run the excavators in the quarries and the fleet of thousands of heavy ready-mix trucks.
Thousands of them, yeah.
If geopolitical tensions in the Middle East escalate and global crude oil prices spike, doesn't that completely blow up their raised EBITDA guidance? Isn't it incredibly reckless to project 17% profit growth when your primary fuel cost could double overnight based on a headline out of the Middle East?
It would be reckless if they were flying blind and completely exposed to the spot market for diesel, sure. If they were just buying fuel day to day at whatever the market price was, a Middle East conflict would decimate their margins. But this is where the financial engineering of CEMEX is just as impressive as their physical engineering. They are not waiting to be victimized by global geopolitics.
Okay, so how do you protect a fleet of thousands of diesel trucks from a global oil shock?
Through aggressive, preemptive financial hedging. The CFO noted on the call that they have already secured approximately 80% of their 2027 diesel consumption through hedging contracts.
Wait, 80% for next year?
Yes.
Let's explain mechanically how this works for the listener.
Essentially, CEMEX goes to the financial markets and buys forward contracts that lock in the price of diesel at today's rates. They pay a premium for this certainty.
Like insurance?
Exactly like insurance. If the price of diesel crashes globally, CEMEX still pays the locked-in rate, which means they miss out on some savings. But if the Iran war escalates and the price of diesel skyrockets to record highs, CEMEX is completely protected.
The counterparty to the contract has to eat the loss, and CEMEX keeps buying fuel at the lower locked-in price.
Exactly, and this isn't theoretical. Management revealed they used their hedging program to offset $32 million in diesel costs just in the first half of this year alone.
That's real money.
Yeah, so even if the worst-case geopolitical scenario plays out, 80% of CEMEX's diesel costs for next year are already locked in. It is a masterful risk management strategy that protects their profit margins from extreme external volatility.
That is the difference between a reactive management team hoping for the best and a proactive management team engineering a floor under their profits. And looking at the transcript, they're being just as proactive with their balance sheet, which brings us to their debt.
Historically, debt was the terrifying dark cloud hanging over this company. Prior to the 2008 financial crisis, CEMEX made some massive debt-fueled acquisitions.
I remember that.
When the market crashed, they were left with a crushing debt load that made the stock highly sensitive and frankly dangerous in a high interest rate environment.
But this call paints a completely different picture. They have been quietly executing a massive deleveraging campaign. During the second quarter, they repaid $1.5 billion in bank term loans and redeemed another $1 billion in subordinated notes.
It's a massive cleanup.
You don't just find $2.5 billion in the couch cushions. Where did that capital come from? Did they just use the $651 million in free cash flow we talked about earlier?
They used a combination of that free cash flow on hand plus a very strategic debt refinancing. They issued a new $1.5 billion 10-year senior note. They essentially took short-term expensive debt that was maturing soon and pushed it out 10 years into the future at much better terms.
Nice.
But here's the fascinating detail that shows how sophisticated their Treasury Department is. They immediately swapped $500 million of those new US dollar notes into euros.
Okay, I saw that in the transcript and it really confused me. Why would a company whose core growth engines are in the United States and Mexico swap $500 million of perfectly good debt into a European currency?
To align their debt currency mix with their physical cash generation profile. Remember, we talked about how profitable their European operations are becoming because of the carbon tax pricing umbrella? Yeah. They are generating a massive amount of cash in euros.
Oh, I get it now. So if you generate cash in euros, but you owe debt in US dollars, you are completely exposed to foreign exchange risk.
Exactly.
If the dollar suddenly strengthens massively against the euro, your euro-denominated cash suddenly buys fewer dollars, making it much harder to pay your interest expense.
Precisely. By swapping the debt into euros, they create a natural currency hedge. The cash they generate in Europe perfectly matches the currency of the debt they owe. If currency markets fluctuate wildly, their ability to service their debt remains mathematically stable.
It is just incredibly disciplined financial plumbing. And the result of all this debt paydown and restructuring is that their net financial leverage, which is the ratio of their total debt to their annual EBITDA earnings, declined to 2.08x.
For context, anything under 3.0x in the heavy materials sector is generally considered healthy. At 2.08x, CEMEX boasts a pristine balance sheet. They are no longer a distressed, debt-heavy turnaround story. They are an investment-grade operator.
And because the balance sheet is so strong, they actually lowered their interest expense guidance for the year down to $455 million. That is a $40 million decline compared to the previous year.
And just to connect the dots for the investor, that $40 million doesn't vanish. That is $40 million of pure cash that no longer goes to Wall Street banks. It goes straight to CEMEX's bottom line. It increases their free cash flow, which they can use to fund growth.
Which gives them the capital flexibility to pivot to something much more exciting than just paying off old loans. And this finally brings us to the hook we promised at the top of the show. The true catalyst that makes this stock so fascinating. The AI tailwind.
This is where the 100-year-old traditional economy violently collides with the technology of the future. Management dropped a statistic on this call that should make anyone holding or considering this stock sit up and pay close attention.
What was it?
They estimate that 35% of all planned or under construction mega data center projects in the United States are located squarely within CEMEX's existing geographical footprint.
I wanted to find mega data center for a second because we aren't talking about server closets in the basement of a random office building.
No, not at all.
The company defines these as hyperscale investments exceeding $500 million each. These are sprawling, massive industrial complexes built by Microsoft, Amazon, Google, and Meta.
Just think about the physics of these buildings for a second. A massive AI data center houses thousands of incredibly heavy server racks filled with GPUs. They require their own dedicated power substations. They require massive industrial-scale liquid cooling infrastructure, which means heavy piping and water tanks. The physical load of these buildings is just immense.
You cannot build these on a standard concrete slab. You need millions of square feet of heavily reinforced, specialized concrete foundations just to prevent the building from cracking under its own weight.
Right, and to put a specific number on the scale of this demand, management estimates that the construction of these AI data centers alone could increase total national U.S. cement consumption by approximately 2% annually every single year between 2026 and 2030.
Let that sink in. 2% annual growth for the entire national cement market, a market that is already massive, driven purely by the build-out of artificial intelligence. And CEMEX has 35% of these projects sitting right in their backyard.
They are already feeling the impact on their balance sheet. The company reported a 185% increase in ready-mix concrete volume supplied to data centers in 2025.
Wow.
And in just the first half of 2026, those volumes doubled again. The CEO noted with immense pride that they currently have a 60% win rate on the data center projects they are bidding on.
A 60% win rate against all other competitors. That is exponential growth hiding inside a legacy business. And what makes this so lucrative for CEMEX is how they benefit across their entire vertically integrated supply chain.
The CEO explained this beautifully on the call. When they win a bid to supply a hyperscale data center, they aren't just sending a few trucks of ready-mix concrete.
Right. They capture the economics at every single step of the build. They mine the aggregate rock from their own quarries. They manufacture the raw cement powder in their own kilns. They supply the specialized chemical admixtures required to make the concrete cure properly for heavy loads. They mix it in their own batch plants, and they deliver it in their own trucks.
Yeah, they are capturing profit margin at every single layer of the value chain.
But the connection between CEMEX and artificial intelligence isn't just external. It's not just about selling concrete to tech companies so they can build servers. The most fascinating revelation on this call was that CEMEX is actually adopting AI internally to run their own heavy machinery.
You are talking about the Balcones plant pilot program.
Yes. The Balcon plant in Texas, ironically, the exact same facility we discussed earlier that got hit by the severe flooding, is currently serving as their global pilot facility for integrating artificial intelligence into industrial plant management.
No, that is wild. How does an AI run a rock quarry and a cement kiln?
Well, they are feeding millions of data points from sensors all over the plant into machine learning algorithms.
Okay.
The AI is being used to dynamically optimize the temperature and fuel mix of those massive kilns in real time, far faster and more accurately than a human operator ever could. It is predicting maintenance needs telling management exactly when a gear or a conveyor belt is likely to fail before it actually breaks down, which prevents costly unplanned shutdowns. And it is dynamically managing their energy consumption based on grid pricing.
The CEO stated that once they perfect this AI integration at the Balcones facility, they plan to scale the technology globally across all of their operations by 2028. This is the holy grail of operational leverage.
It really is.
This is how you take a 21.4% margin, which is already an 18-year high, as we established, and push it even higher. You utilize the exact same bleeding-edge technology your tech customers are building to optimize your own 100-year-old factories.
It is a perfect closed-loop ecosystem. They are using AI to make the concrete that builds the data centers that house the AI. And it leads us perfectly into our final section, the outro. We've gone through the headline numbers, we've broken down the operational story, and we've analyzed the forward guidance.
Right.
If you are an investor looking at this stock, what is the bottom line? We promised an opinionated, actionable takeaway. Based on all of the data we just unpacked, what is the verdict on CEMEX?
The verdict is firmly bullish. For a retail investor looking for exposure to infrastructure, industrial revitalization, and yes, even the AI boom, this stock demands to be on your radar.
Let's summarize exactly why. If you look past the ticker symbol, this is no longer the highly cyclical, dangerously debt-heavy construction play that went into near cardiac arrest during the 2008 financial crisis.
Far from it. This is a fundamentally, structurally transformed company. They are boasting their highest operating margins in nearly 2 decades. They are generating massive, record-breaking free cash flow. They have successfully executed a masterclass in internal cost cutting with Project Cutting Edge, locking in $475 million in structural savings by pruning bad assets and optimizing fuel.
They have completely bulletproofed the balance sheet. They proactively hedged 80% of their diesel costs against Middle East geopolitical volatility. They restructured their debt, pushing maturities out 10 years, matching currencies to cash flow, and lowering their net leverage to a pristine 2.08x.
And most importantly for future growth, they are perfectly positioned geographically to capture the absolute largest construction boom of our generation.
Which brings me to the final provocative thought I want to leave you with today. We started this deep dive talking about the ethereal nature of the cloud and how the digital revolution requires a massive, heavy physical footprint. We have trillion-dollar tech giants spending billions on GPUs and software engineers to build artificial intelligence. But those GPUs have to live somewhere. They have to sit on a foundation that doesn't crack, in a building that can withstand extreme weather, powered by infrastructure that requires millions of tons of heavy materials.
Exactly.
With CEMEX actively piloting AI at their Belcones plant to squeeze every single drop of efficiency out of their heavy operations, while simultaneously pouring the physical foundations for the massive data centers required to power the global AI revolution. Is it possible that this 100-year-old Mexican cement company is actually one of the smartest, most profitable, and most under-the-radar AI infrastructure plays on the market right now?
It is a question that completely challenges our assumptions about what a tech stock actually looks like. Sometimes the most lucrative picks and shovels in a gold rush aren't made of silicon or software. Sometimes they are made of concrete.
I couldn't have said it better myself. Thank you for joining us on this extended deep dive today. We hope this breakdown helped you look past the basic headline numbers, past the Wall Street jargon, and into the real structural mechanics of what is happening inside this company.
Absolutely.
If you're managing your own portfolio, keep questioning the consensus, keep digging into the raw data, and we will see you on the next deep dive.